My name is Mark Thompson, equity analyst here at Howe Rusling. Today I'll be discussing different types of investment styles with you. Depending on one's definition, investment styles can encompass categories from active and passive to large and small cap. But to keep things simple today, I'd like to focus on one of the most common categories of investment styles: growth stocks and value stocks. Growth companies typically have experienced high sales and earnings growth in the past and are also expected to experience this in the future. Investors, on average, are willing to pay more for each dollar of sales and earnings because of this expectation of fast growth and the hope that this premium could grow over time. Since growth stocks are in the life cycle stage of maximizing sales and earnings growth, capital return to shareholders in the form of dividends and share buybacks can be more limited as cash flows are reinvested into the business. Volatility can be higher as well, as investors may quickly discount a company's high multiple if growth expectations do not perform in line with those original expectations. Consequently, a pure growth strategy may be more suited for risk-tolerant investors. Value companies, on the other hand, represent the opposite side of the spectrum. These can typically be companies that are more mature, with a demonstrated ability to generate profits and sound business fundamentals. In many instances, these companies have fallen out of favor for temporary reasons, resulting in investors being willing to pay less for each dollar of sales and earnings. These stocks are past the life cycle stage of higher than average growth and commonly prioritize capital return to shareholders through buybacks and dividends. This emphasis on capital return can help reduce volatility, and thus this category may be more appropriate for more risk-averse investors. Now you may ask yourself, which investment style is appropriate for me? While your Howe Rusling portfolio manager can assist in determining your appropriate level of risk tolerance and asset allocation, our investment methodology doesn't pigeonhole you into one growth or style box. The reality is, growth and value stocks outperform each other at different points in the market cycle. Investors should have exposure to a diversified portfolio of attractive investments, regardless of if they are growth or value. At Howe Rusling, we view the best approach in portfolio construction as being fundamentally driven, using a combination of primarily bottom-up fundamental analysis, but within an overarching macro view. Our two main equity portfolios, core and equity income, use this approach in portfolio construction, and as a result have both growth and value companies represented while still being managed to their individual mandate. So in this sense, we're style agnostic and allow the portfolios to be filled with those companies that, in our view, trade at the most attractive discounts to their fundamental valuation. If you have any questions pertaining to types of investment styles and how it relates to your individual situation, please don't hesitate to contact us. I hope to see you next time, and thank you for tuning in to StreetSmarts with Howe Rusling.